Welcome to the Capital News. I am your host, Alex Kreitis. Today is April 24th, 2019. Thank you so much for joining me. I hope everyone is doing well out there. Let's get right into some of the stock market news today. The S&P was down 6.5 points. The Dow closed down 59. The Nasdaq was down 19 points. And the Russell 2000 was able to eke out a small gain of 3 points for the day. So no new record highs made 2 days in a row on the S&P and the Nasdaq, and obviously the Dow still remains shy of its all-time high, but it's still relatively close. However, the Russell 2000, the small caps, they're still in correction territory, still being down about 10% from their all-time highs back in 2018. Oil is at $65.80. Gold is still below $1,300 an ounce and is now at $1,278 an ounce. Again, we said yesterday it was trading at near 4-month lows, which is still the case today. Silver remains below $15 an ounce and is at $14.90 an ounce. Meanwhile, the 10-year Treasury is down and now sits at 2.522%, which was a decline on the day of nearly 2 percentage points. So again, folks, this is the stock market, for all intents and purposes, going up because it just made all-time highs yesterday, the S&P and the Nasdaq, and the bond market going up at the same time, because you have to remember, especially for those of you who may not be aware, bond prices and bond yields are inversely related. So when you have buying, you bid up the price, which simultaneously drops the yield. So when you have yield suppression, this is basically quantitative easing by another measure. And what this does is it says, well, if I'm not going to get that big of a return on my bonds, it's not yielding that much, well, maybe I should go further out onto the risk curve and get into the equity market. So this is sort of what we're seeing here. This is sort of the game that's being played. Who's going to be right if there's money moving into safe haven assets, aka the bonds, the Uncle Sam, and also going into the stock market? So who's going to prove right? Because typically somebody is proven wrong. My money's on the guys in the bond market, but we will see what happens. Again, we are in the financial world of Oz. Going back to recent discussions we've had regarding Larry Fink, CEO of BlackRock, there could very well be a melt-up in the stock market. And again, that's referring to money sitting on the sidelines that could come into the marketplace, that could come into the stock specifically, because people are like, wow, it's making new highs, fear of missing out, I got to get in. To us here at the Capital News, at this point, I don't know if the risk-reward trade-off is worth it. Be hesitant, be aware of what you're doing, be nimble, and have a strategy to get in, and most definitely have a strategy to get out. Be diversified, get into cash, wait for this day of reckoning that I am telling you will come sooner rather than later, although they will do their best to keep this thing propped up. Diminishing marginal returns are setting in when it comes to quantitative easing and lower interest rates and even debt spending and financing. It will all have a day of reckoning sooner rather than later. So at least have some cash set aside to take advantage of what could be the sell of a lifetime. When there's blood in the streets, buy real estate. Be greedy when others are fearful. Be fearful when others are greedy. Pay attention to those topics. Pay attention to those statements because they ring true more times than not. Look, you're supposed to buy low and sell high. If the market's making all-time highs, yes, you're going to be hopeful that it continues to go higher, but what's more likely going to happen, especially when you take into consideration a whole bunch of the economic pieces of the puzzle that we talk about here all the time. So just use your own judgment, but be careful. So that's the bond market, that's the stock market. Now the VIX gained 7 percentage points today and now sits at $13.14. Obviously, we are still in the earnings season for Q1 of 2019. Facebook reported good earnings and revenue, so that stock is up. Microsoft, same thing. The markets like their news. They both reported after hours, but so far in after hours trading, very positive for those stocks. Tesla, meanwhile, missed their expectations, but is still losing money, but still remains steadfast in their forward guidance. But nevertheless, the stock was down today. Tomorrow, I believe some of the bigger names are Intel, Amazon, and Starbucks. So we'll continue to see a lot of big names coming out reporting earnings. So we'll keep you abreast of what takes place there. But evidently there wasn't a whole bunch today that really moved these markets further to the upside to make new all-time highs. So I don't know if this is just simply a cooling off period, wait and see for some of the other big boys, if they were waiting to see what happened with Facebook and Microsoft and Tesla to report after hours. So we might see some futures, specifically with the NASDAQ, because that's the tech sector. You might have a strong day tomorrow in the NASDAQ. But again, that's going to be contingent on some other companies that report pre-market tomorrow, and even what might be expected for after hours. So stay tuned to all of that stuff. This is the market we're in. Again, when you have the likes of the correction and the bear market, 20% decline in the fourth quarter of 2018, a lot of analysts came down and they overshot to the downside what they thought companies might do in the first quarter. So they had a lower hurdle to jump. So that's the game that's being played, folks, and that's exactly what we're going to talk about today, because we're going to focus on an article that was on Yahoo Finance that has to deal with millennials and thinking that the lottery is a better bet than the stock market. Quite honestly, at this juncture, they're almost one and the same. So it's a shame that people are starting to actually think this, but we're going to get into that briefly. But so before we get into that article, I just want to be mindful to let you guys know, especially those who may not listen to the other podcast that focuses on politics and geopolitics, but take a look at what we talked about today, because we weren't really talking on a lot of the political mumbo-jumbo, the three-ring circus, the Clown Act, all that stuff, whether it's Brexit, whether it's the three-ring circus regarding the Mueller report and the investigation and obstruction of justice and all that crap. We got a little bit more heady today, and we were talking about a recent report that came out regarding the solvency of Social Security and Medicare, and how, of course, it's insolvent, something we talk about on the political podcast and also here. But I don't want to oversaturate the topic right now, especially for those who listen to both, and basically just repeat myself on the same topic. So if you have an interest in focusing and following the Social Security Medicare story, check that out. Check out episode 55A. It's very interesting stuff coming from the government, coming from our commentary, just something to pay attention to, because this is going to have huge implications, not just politically and socially, but obviously economically as well. And it will have negative effects moving forward. Is there opportunity in some of that? Yeah, we're optimists here. There's always opportunity in the dark alleys and recesses of anywhere, but it doesn't mean that they are simply going to be solved, at the drop of a hat, which we've seen this coming for a long time, and we talked about this in our book, The Cynic's Guide to Investing, and that was published in 2015, and the data we used was even from a year or two earlier, and it just rings so true, it's not even funny. It'll just make your head spin. So definitely check out that podcast, and we at the Capital News would definitely appreciate it if you did. Now, moving forward to the article on Yahoo Finance, it is entitled, Why Millennials Would Rather Buy Lottery Tickets Than Invest in the Stock Market. I'm going to read this article to you. It's not that lengthy, but there's some interesting stuff in here, and it's very telling of the times in which we live. So let me begin. Millennials are banking on winning the lottery to fund their retirement, according to a new study by investing app Stash. 60% of millennials think winning the lottery is a reasonable retirement plan, and 18% of all those surveyed are basing their retirement plans on hope of hitting the jackpot someday. Now, I don't know how these questions were necessarily asked, how they were posed, if some people were just joking around. I'm sure that was the case in some instances, but the fact that you have 60% of millennials thinking winning the lottery is a reasonable retirement plan, that's a little bit frightening, folks. Actually, that's a lot frightening, all right? And then when you have 18% saying, yeah, basing their retirement plans on the hope of hitting the jackpot, yeah, that's what we're going to do. Continuing, the chances of winning the Powerball lottery are 1 in 292 million, so basically the entire population of the U.S. Want to try Mega Millions? Odds are 1 in 302.6 million. While it seems like an impossibility, many millennials view retirement savings as similarly far-fetched. Well, I wonder why. If you pay attention to these economic podcasts here, it isn't any question. It isn't any question. The student debt, the credit card debt, 7 million Americans 90 days plus past due on their auto loans. There are some problems in this country. Continuing, according to the Stash report, 76% of millennials are living paycheck to paycheck, and 29% of millennial women have debt and are unable to save. 29% of millennial women have debt and are unable to save. What a shame. 31% of millennial women have no retirement plan at all. So this is at least ringing true with what we've had from other studies come out and say 78% of all Americans are living paycheck to paycheck. So at least millennials, they're 76%, so slightly below the average of what we were told from some other reports, being 78% of all Americans live paycheck to paycheck. It's 76% of millennials are living paycheck to paycheck. And again, I mean, this article just breaks it down for women on this couple sentences here, but 29% of millennial women have debt and are unable to save. Is it any wonder why people are pushing off getting married, having children, buying homes, buying cars? They can't afford cars, they can't afford a house, can't afford children. This is going to have huge ramifications, especially, again, if you tie this back to the Social Security Medicare crisis, because when it comes to Social Security, it's a Ponzi scheme, and you need people to be in the workforce to fund current retirees. That's how it works. So if you're having people that are putting off having families, where's the workforce? Interesting question, isn't it? Continuing, Americans in general are not saving enough for retirement. The average person has just $85,000 saved for retirement, and 1/3 of people have less than $5,000 saved, according to a survey by Northwestern Mutual. Now, this is a little deceiving because we're talking about the average person, right? So when you calculate an average, you're taking all of the accounts, all of the values in the accounts. Well, we know there's a lot of people with zeros, and we know that there's a handful of people with millions and millions of dollars. So what that will happen to do when you add all of this up and then divide by however many people, you get an average. Because you have a small portion of people with millions and millions of dollars in their retirement account or a savings account, it skews the numbers to the upside. So if you might be out there scratching your 85,000, I wish I had 85,000, yada, 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 that's because you really have to look at the median data, because what the median price point or savings data would tell you is 50% are above that value and 50% of the population is below that value. So anytime you're looking at average, you really want to try to find the median if you have it. So Yahoo Finance should know better, unless, of course, they couldn't find the data, which I find hard to believe because I can't think of it off the top of my head, but I know I definitely have seen it. So I will definitely have this. Look, this is going to be a discussion we are going to have very, very often on this podcast because the news, there's always another study coming out. We are in a retirement crisis. We are in many, many crises because of the debt that we have put on ourselves, that we have allowed the government to put on us, the taxpayers and citizens. It's just a snowball effect. We're hitting terminal velocity here, the point of no return, and nobody's even having a conversation about this stuff, which is the most disappointing of it all. Again, let's talk about Brexit and the yellow vests in the three-ring circus in D.C. about Trump-Russia collusion, which doesn't exist, and obstruction of justice. Those are the important points to focus on, folks. Don't you know that? Continuing. Now, that average to $85,000, okay, remember that. That's far less than the $1 million experts recommend you save combined with your retirement accounts like a 401k, Roth, or traditional IRAs or pensions. Of course, there aren't many people out there who actually have a pension anymore. And the likes of the 401k, yeah, they exist. How many people take advantage of them? Not too many, unfortunately. And when you look at the numbers, most people are employed by small businesses, and a lot of small business owners just don't have the time or inclination or the staff to manage a 401k, and so it's not even offered to a lot of people, unfortunately. Now, continuing, though all of these options involve investing, the Stash survey found 1/3 of Americans think investing is too risky. Well, I wonder why. Has it just simply been bought and paid for the past 10 years? And while people may not be able to put their finger on the problem, we talk about the problem here almost on a daily basis. When we had the discussion of the monetary base against the Wilshire 5000, when you have the effects of quantitative easing on the stock market, it's been bought and paid for. It's risky. Of course, millennials know and think something's up, especially when they are debt-ridden with debt up to their eyeballs. They have a fancy degree, but they don't have a job. I mean, wonder why they're skeptical of the system. And it's a shame, because investing is really an interesting thing. It's an interesting category. It's something that everybody should be aware of. And this is the mindset that people are unfortunately putting themselves in. So when there's another downturn, a whole host of people are not going to trust this thing at all. And in a large respect, rightly so. But I told you before, when there's blood in the street, buy real estate. That's your opportunity of a lifetime if you have the stomach for the volatility and you have the money saved up. All right. But, going back to the article, but Erin Lowry, the author of Broke Millennials' Takes on Investing, says it doesn't have to be, meaning too risky. She says the key to retirement savings is to start early and start small, and I agree with her 100%. She continues, she says, I would recommend starting small, saving 1%, then every 6 months try to increase it by another percentage point until you reach your goal. It's a slow way to reach your goal while not putting so much pain on your month-to-month budget. That is a way, get your toe wet, get into the habit of saving money. It's a great skill set to have, believe me when I tell you. Starting in your 20s and 30s allows time for the money to benefit from compound interest, something Lowry says is crucial to having enough saved for when you are ready to retire. Very, very true. Quote, the worst case scenario to me is if you get into your 50s and you've done nothing to prepare for retirement, because that means probably 3 decades have gone by where you didn't take advantage of compound interest. True statement, 100%. How many people unfortunately fall into that hole that you're in your 40s and 50s and you have not started to save for retirement at all? You might have a savings account, which is good, but have you put it to work in an account that's really yielding interest? Because for the past 10 years, plus with these extremely low interest rates, by design, by our central bankers the world over, you ain't earned anything. You're not earning anything in your checkings account. You're not earning anything on your savings account within these banks. It has been a huge ripoff. Again, this goes right back to quantitative easing being the biggest wealth transfer in the history of mankind. Don't just take it from me. Take it from some of the best investors. Take it from hedge funds the world over. All right? Now, getting to compound interest. This is a very interesting topic, and it's one that we cover in the Cynic's Guide to Investing. So this is a great day for the Cynic's Guide to Investing to be plugged here today. We plugged what we discussed with the Social Security and Medicare debacle, and now we're going to get into compound interest, because a lot of people don't understand compounding interest. It really is a miracle, because you just have to sit there and let time do its thing. But that is something that's very difficult for a lot of people, and that's why most people are in the market, out of the market, in the market, out of the market, because they can't stomach the volatility, or they don't have a full appreciation and understanding, of compounding interest. So let me just give you a few examples here of what we went through in the Cynic's Guide to Investing. So let's just assume a few different scenarios. We're going to look at a scenario where you are earning 3%, where you're earning 5%, and where you're earning 7%, okay? The differences over time add up big time, all right? Now, just let's assume that you started investing $100 a month at 3%, all right? And you do this consistently, religiously for 40 years. At the end of those 40 years, you're going to end up with almost $93,000 in your pocket, all right? That's not a bad score for only $100 a month. I would hope most people out there could do something, change some behavior to end up with $100 in their pocket that they could end up putting to work for themselves, for their future self. Now, same scenario, 3%, but let's say you're really living within your means and maybe you can come up with $500 a month. That would be fantastic. At the end of 40 years, you would have over $460,000. All right, fantastic amount. Now, if you're really frugal, or you're working your butt off, or you just have a good job, and you can somehow save $1,000 a month and do this religiously for 40 years, 3% again, you would have over $920,000. So quite the difference. Quite the difference. And that's something that you guys have to pay attention to. This is how you do it. And again, and earning 3% is very doable in the stock market long-term averages, especially if you have dividend stocks, preferred shares, whatever. I mean, right now, just looking at the 10-year, I mean, you're at 2.5%. It's only a matter of time, folks, before these interest rates start to go up. I know people think otherwise, but I think interest rates will have a mind of their own. I think the market will take over. It will overpower central banks and federal governments, and the marketplace is just going to say, okay, we've had enough of this crap. Everybody has to come back to reality. Markets have to return to fair value, and that's what's going to happen. It is going to happen in our lifetimes. I know you have the likes of Larry Kudlow, the economic advisor of the president, out there saying we're not going to see higher interest rates in my lifetime. Again, I hope Larry Kudlow is healthy and isn't planning on taking a bridge. Now, that might be true in regards to central bankers not wanting to increase interest rates anytime soon or in his lifetime, but I think the marketplace is going to say otherwise. But we will see what happens. Continuing with our analysis, but here at the 5% level, not the 3 but the 5, same things I'm going to look at. $100 a month for 40 years, $152,000. $500 a month for 40 years at 5%, $760,000 in your pocket. What about $1,000 per month at 5%? Now you're at over $1.5 million. There you are, folks. Again, 5% is reasonable. Just investing in the S&P 500 over the course of this time. Again, making sure that you are investing in dividend-paying stocks as well, because that's where the money comes from. That's where a lot of the returns in the marketplace comes from. I mean, if you want to invest, you want to get paid, right? Well, you got to make sure that you're owning dividend-paying stocks. And with companies that have a really solid track record of protecting their dividend in times of trouble, but also having a very solid history of increasing their dividend as time progresses. I mean, you want to invest, you want to make money. That's a great way to make sure that you are getting paid for your investment. Now, obviously, you're going to more likely see those types of companies that are very well established, which is why they have the cash flow and they're going to reward their investors. Typically, if you're going to invest in small cap companies, you're not going to get a dividend because they're small cap. They're really trying to grow, and they're looking at every single dollar as a means to invest in research and development, acquisitions, whatever the case may be. So that's just something to be mindful of. But 5% is highly doable as well. Now look at the 7% example. Again, we'll look at the same three numbers. $100 a month for 40 years at 7%. Over $260,000 in your pocket. $500 a month. Over $1.3 million. Now you're really starting to make some money. $1,000 a month for 40 years at 7%. Over $2.6 million. Just doing this religiously like clockwork. Believe me, after the course of a few months or a year, it's just going to be on autopilot. You're going to look at this money as your money, obviously, because it is, and you work hard for it. But you're going to be like, well, it's doing its thing. It's doing its job. I mean, don't get me wrong, it takes a while. You really sort of at the 20, 25, 30 year mark is really where you start to see exponential growth. But I just mean just simply the behavior of doing it for several months, a year. You're just going to say, you know what, it is my money, but it's money that I don't need because you've conditioned yourself to not need it. That's why you're saving it. And then when you look and you think and you do the math and you say, my goodness, if I don't touch it, if I just keep it there, my future self is really going to thank me because I'm going to have $1 million saved up. I'm going to have $2.5 million saved up when I retire. Now, obviously, this is truer for those who are listening who are younger, who are 20, 30 years old, but nevertheless, it's never too late to start, and the earlier the better, which is exactly what was said in the article that we read from Yahoo Finance. And we here at the Capital News believe the same thing, and the numbers prove it out. It is very difficult to remain in the market amidst volatility, especially when you have events like a 2008, a 2009. But again, you have to look at those events as events that don't happen all that often, and they don't. I unfortunately am anticipating another one in the near future. But again, you have to look at those as opportunities. Those are going to be the sales of a lifetime. When there's blood in the street, you buy real estate. When people are fearful, you become greedy. That's how you make your money. You buy low, you sell high. Because the companies that will be remaining after what is likely to happen to be a huge day of reckoning, is only going to leave the strongest of them, because I really don't believe that the federal government is going to have the means to bail out all of these banks again and all of these corporations again. They're just not going to do it, because I think Uncle Sam is going to be in trouble, and Uncle Sam is going to save his rear end before he goes out and starts saving a whole bunch of big corporations, especially given the fact that they did so only 10 years ago. So I don't think the political appetite is going to be there to go back and bail out billionaires. So that's just my take on it, but I think that would be true. So take compounding interest very seriously. For those of you out there who have young children or grandchildren, buy them this book. Get them involved with investing. It's math, people, at the end of the day. It's math. You don't have to be a stock whiz. You know, and the other thing that you have to look at, and we talk about this in the Cynic's Guide to Investing, is what type of funds to get involved with. Look at your expense fees. Look, you go to work to make yourself rich and to enrich the lives of your family. You're not going to work to make sure that all of that hard-earned money, when you start to invest it, is going to make other people very wealthy. Okay, you're working for yourself. That ain't a crime. That's what you're doing. That's what you're supposed to do. Okay, make sure you're not getting ripped off with a huge amount of fees that may exist within the mutual fund world. Okay, so be very mindful of that, and we talk about that in the book as well. So I'm going to leave it there, but again, check out the Social Security and Medicare podcast, 55A. Interesting stuff. We're going to continue to talk about this because we have a retirement crisis. We have a debt crisis, and nobody is talking about it. But that doesn't mean we're going to stop. As a matter of fact, it's going to be full steam ahead from here, because these are the things that we must demand our quote-unquote leaders start to tackle. Thank you so much for joining me today, ladies and gentlemen. It's been a pleasure having you, as always. Please like, share, subscribe, get the word out, leave your comments. We would love to hear from you. This is the Capital News. I am Alex Karitis. Godspeed.